Target announced an immediate and full retreat from its ambitious diversity, equity, and inclusion initiatives. They're gutting their DEI executive roles, dropping all diverse supplier goals, and scrapping their in-store cultural merchandise programs. This isn't just a political pivot, it's a strategic business decision that cost them billions. Between May 2023 and May 2024, Target's stock price slid over 20%, wiping out nearly $16 billion in market cap. Was this massive value destruction the driver for their recent backtrack? We're going to dig into the numbers and explore how this single decision impacts everything from their bottom line to their workforce, and what this actually means for other companies eyeing similar programs in 2026. And by the end, you'll see exactly what kind of bill other companies are looking at if they don't get this right. The number is bigger than you think. Alright, let's talk about Target. You might have heard about their recent decision to scale back on diversity, equity, and inclusion initiatives, specifically ditching their 2026 DEI goals and some supplier programs. The big headlines were all about the culture war, but the real story, the one that tells us about billions of dollars, is far more complex than just a social debate. Back in 2020, Target set ambitious targets. 5% of their marketing budget dedicated to black-owned media, a promise to spend $2 billion with diverse suppliers by 2025, and a workforce diversity mirroring the U.S. population. These weren't just feel-good statements, they were public commitments with hard numbers. Fast forward to 2024, and Target is quietly walking many of these back, pivoting to a more enterprise-wide approach to inclusion. What does this mean for someone trying to understand how big companies make these decisions? Well, when you look at their 2023 financial results, Target reported a 4.4% decline in comparable sales and a 3.7% dip in net earnings, totaling about $2.7 billion in lost sales compared to the previous year. This wasn't just a blip, it was a significant hit to their bottom line, impacting their stock price and shareholder confidence. The lesson here is that even the largest corporations operate under intense pressure from Wall Street, and that pressure almost always comes down to profitability. Target's market cap absolutely imploded, dropping by $15 billion in just 10 days, a direct result of their 2023 Pride collection. Rewind to 2020. Target had cultivated this public image as a progressive leader, really leaning into initiatives like their Racial Equity Action and Change, or REACH, committee. They were vocal, visible, and built a brand around it. But then came May 2023, and their Pride collection hit stores. The controversy really ignited around items designed by Eric Carnell of Abprallen, specifically merchandise some consumers labeled as satanic or pro-trans. This wasn't just a quiet grumble online, it sparked an immediate and severe market reaction. The boycott calls went viral, and the financial fallout was swift. Target's stock price, which was hovering around $160 per share in mid-May, tumbled to roughly $130 by early June. That 10-day period wiped out an estimated $15 billion from their market capitalization. To put that in perspective, that's more than the entire annual revenue of companies like Etsy or Dollar Tree. The pressure was so intense that some investors were openly calling for CEO Brian Cornell's resignation. Target was forced to pull controversial items from stores, and there were even reports of confrontations impacting worker safety. This financial and reputational crisis wasn't just a bad quarter, it was the direct catalyst for a fundamental re-evaluation of their strategy. The question then became, how do you quietly dismantle something that was once so central to your public identity? But despite meeting or even exceeding their ambitious 2020 DEI targets, Target made a quiet, strategic decision to backpedal. So, what happened after their initial $15 billion loss? Target's initial DEI commitments were clear and bold. In 2020, they pledged to spend $2 billion with diverse suppliers by 2025, increase Black team member representation by 50% by 2025, and boost diverse leadership by 20% by 2023. These weren't just aspirational goals, they were largely achieved. By 2023, Black team member representation had already increased by 49%, just shy of the 50% target, and diverse leadership saw a 21% increase, exceeding their 2023 goal. They spent $1.5 billion with diverse suppliers by 2022, well on their way to the $2 billion target. Yet, starting in late 2023, a subtle but significant linguistic shift began. Diversity, equity, and inclusion, or DEI, started disappearing from official communications, often replaced by softer phrases like belonging and inclusion or talent development. Take their 2023 ESG report, for instance. Where specific DEI metrics and goals once stood prominently, you'll now find them conspicuously absent. This wasn't just a word change, it signaled a deprioritization. Internally, resources and visibility for DEI initiatives reportedly decreased, a stark contrast to the initial fanfare, despite hitting those targets. It's a classic corporate move. Achieving the goal, then subtly pivoting away when the public sentiment sours. It makes someone in an executive position wonder if setting these goals in the first place was a smart move or an expensive liability. What could possibly compel a company to backtrack on something they had so visibly committed to, especially after successfully implementing it? But here's the thing. Despite reaching those goals, Target still faced an unprecedented external attack that fundamentally reshaped its strategy. This wasn't just organic outrage, conservative activists strategically weaponized Target's DEI initiatives. Groups like the American Family Association, led by figures such as Monica Cull, launched highly organized boycotts in May 2023, directly targeting the Pride collection. Their core argument wasn't just about product choice, it accused Target of pushing a woke and anti-family agenda, influencing both product lines and internal corporate policies. The pressure wasn't just external. Shareholder activists, often linked to these conservative groups, also got involved. They began threatening proxy battles, demanding changes to corporate governance, and even linking executive compensation to a retreat from DEI. This was happening against a backdrop of rising anti-ESG sentiment across the U.S. States like Florida and Texas were passing legislation restricting investment in companies with explicit ESG or DEI commitments, creating a politically charged environment where these initiatives became liabilities. For instance, in 2023, Texas adopted a law prohibiting state investment in financial companies that boycott energy companies, a move often interpreted as an anti-ESG stance. This sustained, coordinated pressure from right-wing activist groups and political forces directly correlated with Target's corporate retreat. It wasn't just about sales dips from the boycott, it was about protecting their brand, their stock price, and appeasing a powerful, vocal segment of the market and investor base. The lesson here is that even when a company meets its stated goals, external political and social forces can still compel a dramatic strategic shift. Which makes us wonder. What does this mean for their 2026 strategy, and what isn't Target telling us about their plans for the future? Target's market value didn't just recover, it soared, but behind the scenes, a completely different game plan was being deployed. After the dust settled and that $15 billion was lost, Target quietly introduced its enterprise growth strategy in March 2024, internally dubbed the 2026 strategy. This wasn't a press release, this was an internal document, strategically reframing their approach to diversity. The core of it? A subtle but significant pivot from broad DEI initiatives to talent development programs, specifically targeting high-potential diverse individuals. Instead of company-wide unconscious bias training for every employee, the new focus became inclusive leadership training for managers. The lesson here is that Target learned that explicit, company-wide DEI mandates were a lightning rod. And remember that $2 billion diverse supplier goal by 2025? It morphed. The 2026 strategy still talks about diverse suppliers, but the language shifted to accelerating diverse-owned business growth through Target's own growth initiatives, rather than direct procurement mandates. For example, instead of committing to buy X millions from a diverse-owned candle company, they might offer mentorship programs or marketing support. This move allows them to claim continued support for diverse businesses without specific, measurable spending targets that can be easily scrutinized. The rationale for someone in Target's position is clear. Maintain an image of inclusion while strategically de-emphasizing specific demographic targets that invited activist backlash. What this means is that Target, and many corporations in similar situations, isn't abandoning the idea of diversity entirely. Instead, they're adopting a more politically palatable, less transparent approach. The uncomfortable truth about corporate values is that they're often far more flexible than we'd like to believe. But here's the most uncomfortable truth. Target actually achieved, or was well on its way to achieving, many of its aggressive DEI targets before the public backlash even began. By 2022, they were on track to meet their 2025 goal of increasing Black team member representation by 50% and had already boosted diverse leadership significantly. This wasn't a failure of DEI programs to deliver on their stated objectives. The shift in Target's 2026 strategy isn't about those programs being ineffective, it's a direct consequence of market and political pressure. The real motivation behind this pivot wasn't a sudden change in fundamental values. It was a calculated move to protect market share, safeguard their stock price, and, notably, preserve executive positions. CEO Brian Cornell, for instance, remains at the helm. When Target announced its enterprise growth strategy in March 2024, there was no mention of the $2 billion diverse supplier goal, nor the specific representation targets that were once so prominent. Instead, the focus was on inclusive products and experiences, a subtle but significant reframe. What this means for someone looking at corporate statements is a powerful lesson. Target is a textbook example of how easily corporate values can be reshaped when they become a financial liability. Remember, this is the same company that proudly stated in 2020 that diversity and inclusion are fundamental to our business success. Fast forward to 2023, and facing a $15 billion market value drop, those fundamentals suddenly looked very different. The uncomfortable implication for consumers and even Target's own employees is that corporate statements on social issues are often transient. They are subject to the loudest opposition and immediate financial consequences, rather than deeply held, unwavering convictions. The lesson here is that a company's deepest commitment is often to its bottom line and shareholder value, and everything else can be adjusted accordingly. So, what does Target's 2026 strategy, and its quiet pivot, really tell us? It's a stark reminder that while companies might champion diversity, equity, and inclusion, especially when the market is stable, these commitments often take a back seat when shareholder value is on the line. The lesson here is that corporate values are frequently more reflective of public relations and market sentiment than deeply held convictions. Target's $15 billion loss in market value, driven by activist pressure, proved to be a far more powerful motivator than any pre-existing DEI goal. This isn't just about Target, it sets a precedent for how other corporations might respond when navigating similar culture wars in the future. We've seen similar dynamics in other sectors. Have you ever noticed a company publicly shift its stance on a social issue after a significant financial hit or activist campaign? What was the outcome? Share your observations in the comments below. For more deep dives into how corporate strategy and market forces really play out behind the scenes, make sure to hit that subscribe button. And if you're curious about another retail giant that faced immense pressure to change its business model due to shifting consumer sentiment, watch my breakdown of Disney's streaming battle next.